pay attention to the rule of three. I alluded to this earlier. The rule of three is very important, and it suggests that breakouts occur on the third attempt to penetrate a support or resistance level. When a third attempt fails, it often means the reversal will occur. So if I see a consolidation phase, let's say I'm trying to get the first leg even out of a consolidation early in the morning, and I see it going up and down, I'll count the tops and bottoms. I even number them on my screen sometimes. One top, two tops. Next trip up, it should go if it's going to break out and rally. If it goes out and comes back down, I know it's no good to the upside, and I have to be a seller. Vice versa. One bottom, trades up in the consolidation, back to the lows, second bottom, up, third time down. If it's going to break, it'll usually break on that third time. And remember what I'm trying to do, I'm trying to trade it in that consolidation. I don't want to trade the breakout. On the breakout, it's all buyers or all sellers. And if you're one of those buyers, you're going to get a bad fill, and you're going to have to pay up to get in. If you're one of those sellers, when it's going down, you're going to get a bad fill. So I want to do it in the consolidation and then let it run my way. And when it runs out of steam, I'm selling into the rally or buying into the sharp break. On page 102, I have an example of that, and I have it numbered, in fact. The market attempts to break out on the third attempt. So you have one high, a second high, which went a little higher to get the stops, down again. Now in this area in here, it should go on the next penetration. And look what happens. It does indeed run right up, and it makes the high on that. Here's an example on page 103, even a clear example of the rule of three. One trip to the bottom labeled 1, second trip a little lower to get the stops, then up again. And as it goes up and you see it starting to trade off, you say to yourself, this is it, the third time it'll go. It should go. What happens is it penetrates it, it stalls out, and then there's a sharp move down, a little bit of bounce, and then it sells off sharply from there, right into the noon hour, by the way, when it should stop. So that's a good illustration of it on 103. Now I mentioned stochastics briefly. This Rule 19 deals with how I use it. I use it as a confirmation tool on price reversals. And there's a variety of indicators I use as confirmation tools. What I'm trying to do is line up all my ducks in a row, and the more confirmation indicators I have that say it's going one way, the more confident I am in the position. What's going to happen, though, more likely in reality, is one indicator says one thing, or you could analyze it as going either way, and another says another. Then it's a little tougher. But what happens is you get these confirmations which tell you, there's more evidence here that this market's going either higher or lower, and that's the way you want to go with it. So the slow stochastics I use primarily is that way as an indication that the direction that prices are going is the correct direction, or perhaps it's telling me prices are going higher, but the quality of this rally isn't quite as good as I thought it was, and as a result, I'm going to start going the other way. Here, a divergence between price and slow stochastics suggests market reversals. This is particularly effective when used as a confirmation tool with time and price measurements. And here's an illustration of it on page 105. You have prices declining to new lows on the second trip down. The slow stochastics fails to go lower, and as a result you have the divergence. That means it's a buy indication. Secondly, on 106, prices rise to new highs. The divergence is in the stochastics, which fail to go to new highs. Now, you can look at 5-minute I run a slow stochastics on both my 5 and 1 minute bars. You'll get more on the 1 minute. The problem is very often by the time you identify it, the move is already about to be over. So then you can go to the 5 and see if it's also the divergence there and it's not over, there's more left in it. But that's really the difficult side of it. And also, there are times in the day and this is very important, by the way, when you have to ignore the slow stochastics, such as late in the day when you have a huge rally underhand and you're about to see a slow stochastics tell you there's a divergence. You got to ignore it at that point, because when you get those big rallies late in the afternoon or big breaks, nothing's going to stop it. So you have to be aware of that. Like everything, it won't work all the time. On 107, I've got an illustration of the market trading up. Prices go to new highs. The slow stochastics is in a divergence with that. It says no, and sure enough, it sells off. On 108, prices again break down to new lows. The stochastics aren't breaking to new lows. There's something wrong here. That means there's probably a reversal. You often get these sharp reversals when the market breaks really hard. To understand this, you've got to remember the psychology of the pit traders and the psychology of your fellow traders off the floor. Let's say they think the market's going to go up and they've loaded the boat long. It starts to break. The guys on the floor start to sell it, and then the people on the outside start to sell it, and soon the whole world wants to sell. Well, it gets overdone, and what will happen is it'll snap back very quickly. Not long ago I was trading. I saw this pattern come up. It started to break like a rock. I ran in and bought it, and sure, I was underwater for about a half a minute, but about 2 minutes later it was on its highs and soaring higher. And the reason is it just got overdone momentarily, and it was one of these sharp breaks to get the weak longs out so they could really take it up. This is Taylor all over again. The market's engineered from within. It goes down to go up, it goes up to go down. Even if it's going down, they're going to run all the stops on the upside first. Then it'll go down. This is why I'm very careful where I put in my buy and sell orders. Because if I put in a sell order prematurely and they run it up on me, I may get spooked out and buy the top. But if I put in a sell order and see that happen and see the pattern where it sells off and it ends at the low of the 1 minute bar after it went into new high ground to get the stops, I know it's going lower. And then I really start to sell in a serious fashion. Rule 20 on 109. A good place to enter and exit the markets when the stops are being run. We mentioned this. It penetrates these often by several ticks. Now you need to know how to read the market, to know if it's stop running or whether it's the real thing. And to do that, you got to know a little bit about the time of day and what stop running looks like and what the real thing looks like. First of all, a short cover rally means the market is driven up as short sellers buy the market in a panic fashion to get out at any cost. So what will it do? It'll go 70, 80, 90, even, 10, 20, 30, 40, and then go dead. And then it'll go 30, 20, 10, even, 90, and so on down. It'll happen quickly. Up fast, dead, and down. That's usually a stop running. It's usually a short covering rally when that happens. They just spook out the shorts, and that causes the market to go up and then come immediately down. Now that's more apt to happen in the morning or at noon hour. But late in the day, if you get the real thing, a rally, it'll go 70, 80, 90 even, 90, even 10, 20, 10, 10, even 90, and then even 10, 20, 30, 40, and up. In other words, every time they knock it down, buyers rush in and buy it and push it higher. It's almost palpable when you see that happen late in the day, because it means the market is going to run substantially higher, and it's getting ready to do that. And that's a whole different animal than the short cover rally where it goes up quickly, goes dead, and comes back. If it's any good, it won't come back. It'll go up, down a couple of ticks, and then up. So it's good to know the difference between when the stops are being run and when the real thing is occurring. So it often, when they run the stops, what they do is they penetrate it by a few ticks. There's a little more left in it. It goes up, it stops, and comes back. And again, you got to know the psychology involved here. Where should it go? It should go above intraday, and intraday highs and lows. Why? Because that's where the stops are. How does it do that? Well, there's guys on the floor, highball it and lowball it. Highballing means you take it up yourself. Remember what I said before about if it's 80 bid, the whole pit is 80 bid or higher. So somebody bids 90, somebody bids even. Why would they buy the top? Because if they lose on a one lot, it doesn't matter to a 100 lot trader. He wants to get it up there, muscle it up, and then you guys, the stops, do the rest. Because your brokers then go even bid, 10 bid for it, 20 bid for it, 30 bid. Remember, a stop becomes a market order when it's hit. And all they're doing is trying to get you filled, and the only way they can get you filled is to take the market up. Now, in a panic situation, it's a lot worse than that, because now we're talking about even offers and even bids rather, and half offers. So just to get in and out is going to cost you 50 points, and that really adds up if you have a big position. And so Rule 20 says both inter and intraday highs and lows are powerful targets for stop running. As a result, the market often penetrates these prices by several ticks, participating a rate on the stops prior to reversing direction. It's important to pinpoint these critical price areas before they are reached. When stop running begins, the reversal's often quick and certain. So you have to be aware of these things, and it's not an accident that your stop was hit and it ran the other way. All it means is that you're putting your stop in the wrong place. You're putting it where they can get it. And I know you got to walk a thin line here. If they're too close, they're going to be hit, and if they're too far away, you lose too much money. I don't use stops for the reason that I have quick access to the floor, and I watch it like a hawk when I'm in the position. I don't take my eyes off the screen. But you have to be aware of stop running, because it happens frequently. Some days it happens, like I said, in the search and destroy days all day long. Fortunately, that day, the search and destroy day, only occurs about once a month, if that. And it usually comes out of nowhere, and you don't know what day it's going to happen. But the way to deal with that is if you have more than 3 losses, it usually helps to stop trading for that particular session and wait for the next either afternoon or morning session to get in.